/CHN. Good morning, everyone. Today's market is showing a clear divergence, with a noticeable shift towards a risk-off sentiment. We saw the Nasdaq 100 ETF, QQQ, close at $713.15, while the S&P 500 ETF, SPY, finished at $741.25. Concurrently, the VIX Volatility Index climbed by 1.61% to 17.72, and the 10-year U.S. Treasury yield rose to 4.62%, both indicating that risk asset valuations are coming under pressure. The core driver behind this shift is primarily the latest hawkish minutes from the Federal Reserve, which have pushed the market's expectation for a July rate hike to 37%. Against this macroeconomic backdrop, the dominant market direction for today is expected to be volatile with a downward bias. We observe a lack of upward momentum, largely suppressed by a dual impact: firstly, the post-earnings exhaustion in tech giant Nvidia stock, and secondly, China's weaker-than-expected retail sales data for April, which saw only a 4.2% year-on-year growth, casting a shadow over global growth prospects. In terms of capital flows, we are seeing clear risk-off signals. Funds are actively moving out of technology and growth stocks, as well as emerging markets including A-shares, and reallocating into the energy sector, with Brent crude briefly touching $108 a barrel. U.S. Treasuries are also gaining traction due to their safe haven appeal, with solid demand seen in the 10-year Treasury auction. Looking at the global capital path, the Asian session has already confirmed this risk aversion, with the Shanghai Composite Index closing down 2.04%, hitting a two-week low. We anticipate this negative sentiment is highly likely to extend into the European and U.S. trading sessions. The combination of a hawkish Federal Reserve and slowing growth in China provides a clear impetus for global capital to seek safer havens. Diving into the macroeconomic drivers, interest rates are undoubtedly a significant headwind. The mention of a potential July rate hike by some Fed members, coupled with lower-than-expected initial jobless claims at 214,000, reinforces the expectation of rates remaining higher for longer. The U.S. dollar index, DXY, is currently struggling around 99.34, with its short-term direction unclear. While rate hike expectations support the dollar, Goldman Sachs' report on overvaluation and capital outflows create a counterbalancing effect. Inflationary pressures persist, with EU sanctions pushing Brent crude above $107, and this reflationary pressure is limiting central banks' room for monetary easing. Geopolitical risks also continue to be a negative factor. The new round of EU sanctions is not only exacerbating energy market volatility but also increasing global supply chain uncertainty. Regarding core assets, we hold a bearish view on U.S. equities. Despite Nvidia's better-than-expected earnings, a slowdown in its data center business has raised market concerns about the trajectory of AI growth. Tesla's decision to cut production due to demand issues further dampens sentiment for growth stocks. We see support for the S&P 500 ETF, SPY, at $735 and for the Nasdaq 100 ETF, QQQ, at $710. The A-share market is currently dominated by pessimistic domestic sentiment, as April's retail sales data disappointed, eroding confidence in consumption recovery, and the central bank's limited liquidity injections proved insufficient to counter the downturn. Foreign capital inflow intentions are diminishing under the dual pressure of RMB exchange rates and economic data. Bitcoin, as a high beta risk asset, has seen $120 million in ETF outflows over 3 consecutive days, validating its role as a risk-off signal. In commodities, energy benefits from ongoing supply-side risks, with WTI crude oil finding strong support above $100 a barrel. Gold, however, is facing profit-taking pressure around $4,500 an ounce, with ETF holdings decreasing by 2.5 metric tons. Today's capital mainlines are very clear: first, a long energy and short technology trade, a direction that appears sustainable. Second, an overweight position in U.S. Treasuries and an underweight position in emerging markets, which is expected to be a dominant trend in the short to medium term. Looking ahead over the next 24 hours, we predict that the tech-heavy QQQ ETF will fall by over 1%, testing the $710 psychological level. The CSI 300 index is expected to remain weak and struggle to reclaim 4,750 points. Bitcoin's price may break below $77,000. WTI crude oil prices are anticipated to remain above $100 a barrel. Market breadth today is set to deteriorate, with declining stocks in the S&P 500 outnumbering advancing ones by more than a 2-to-1 margin. In summary, the probability of an upward